Principles of Finance, a la shmup. The fee structure of funds. Fee fi fo fum. We interrupt this epic story to bring you a bunch of fancy terms. Venture capital, private equity, growth capital, hedge funds, mutual funds. Well, what do they mean? The basic idea is that investors give these people money to make more money. Bigger, fatter, morer. Each of the above flavors is just a different investing style in which to make that money. Each investing style and each fund features its own unique set of structures and or fees. That's the money that you, the investor, pay the money managers to go make you more money. But okay, first things first, it all starts with a big bag of money. Say a doctor opened a chain of exam clinics and she ended up owning the real estate under those clinics. And then a decade or so later, she sold the whole thing for $80 million when she was still young enough to enjoy her winnings. After tax, that $80 million in the blue state in which she lived became $50 million. Well, she bought a nice home, a small ranch, a small jet, and had $20 million left over to invest. Well, half of that money went to a nice conservative, dividend-loving mutual fund. The other half went to SPICE, or alternative investments. That's what those things are, the fancy names we gave you at the beginning here. They're any of the not mutual or not index fund flavors. Yeah, those are vehicles through which rich people invest. But what's the difference? Well, we can start with the fees that the managers charge people, like the good doctor. Well, the fee structure in these kinds of funds is vastly different among the asset classes and vastly more expensive. Like you can expect to pay 1% a year for a mutual fund, maybe 0.5% a year for an index fund. Well, the venture, private equity, hedge funds, those guys are 10 to 100 times that price. Why? Well, in theory, they make a lot more money. In practice, they don't. So here we go. The most common fee structure is what's called a 2 and 20 fee structure, and that exists in pretty much all hedge funds. So a given hedge fund has $1 billion under management, and they take 2% a year, $20 million, for the pleasure of just managing the money. That's if they break even. They start with $1 billion, and then they make 2% on their money, and at the end of the year, they have $1 billion. That 2% that they made all went to them, the money managers, to keep as their fees. They don't get rich on that 2%, and it costs a lot of money to employ lawyers and secretaries and auditors and send out those fancy, beautiful lambskin mailers and all the other crap they have to file with the SEC and trading stations and on and on and on. All that costs money, and that's what 2% covers. But then if they have a great year, like they're up 50%, that $1 billion goes to $1.5 billion, well, then after they've paid their 2%, that's, we'll throw that in there as a forget it because it makes the math harder here. So we have $500 million in profits. Well, that hedge fund, the 20 is 20% of profits. They keep 20% of that $500 million or $100 million. That's what their take is. So you, the investor, or at least your fund, ends up being worth $1.4 billion, not $1.5 billion when they clip their coupon for their fees, and most clip them quarterly or thereabouts. Anyway, that's how it works. So when you hear 2 and 20, that's what it means. And the venture capital elite in Silicon Valley make 2 and 30, meaning they take 2% management fee and 30% of profits. So yeah, it's just crazy expensive. Yeah, when you compare it with a mutual fund at 1% and an index fund at 1/3%. And the reality is there's no such thing as a venture capital fund, for example. There's a half a dozen, maybe a dozen who are really good and produce good returns for investors year after year. But then there's like 1,000 who suck. But everyone wants to buy a lottery ticket, and people spend a lot of money buying lottery tickets in the real world and actual lottery tickets. Well, why wouldn't rich people be the same? If you're a doctor who made all your money probing your fingers into people's private places, why would you know anything about finance, particularly venture capital, which is an arcane, random, difficult to understand, highly technical, technological area of the world? But you like lottery tickets, you like jets, you love hearing stories about the founders of Google buying islands and ex-army boats to land their planes on and stuff like that. So why not? Roll the dice, right? Yeah, it's great until you lose all your money. Well, let's dig into this venture firm thing then as a deeper example here. That doctor, our friendly prober, gives $5 million to 2 and 25 venture firms. That's like a middle tier venture firm, which turns it into $10.7 million 7 years later. 5 into 10.7. Well, the firm clips a 2% per year fee from her $5 million. That is, she is paying them $100,000 a year to manage her $5 million. So in the beginning of the fund, her $5 million value is slowly destroyed. It's worth $4.9 million after year one if no investments are made. And then they make a few, and well, they pray a lot. And then they get lucky and they find a winner, which pulls up the whole fund to be worth double. Well, in the process of those 7 years to manage her $5 million, she paid them, yes, $700,000 in guaranteed fees. And then when the firm showed $10.7 million in net gains, well, after subtracting the $700,000 in fees, the original investment of $5 million, there was $5 million left for attribution to carry or profit participation. Well, the fund was set up as a 2 and 25 here, so the general partners keep 25% of the $5 million in profits, or $1.25 million, as their, quote, incentive to work hard bonus. So the doctor put in $5 million. She made a 12% per year return on her investment, slightly better than an average S&P 500 run with dividends reinvested. Well, she was lucky to be in a top 10% performing venture capital fund. Yes, that's what the top 10% does. Not very impressive. And in the course of those 7 years on a $5 million investment, she paid the firm $1.25 million in carry plus $700,000, or about $1.95 million in fees. Sound a bit steep to you? And this was a top 10% performer. Most venture funds still collect the fees, but don't even return capital invested. That is, the expected case would be for the doc to put in $5 million and after 7 years, get about $3.8 million back. Like, that'd be the median return. So why on earth would anyone then be an investor in the venture capital business? Lottery tickets. Every now and then, there's a fund that returns 50 or 100 times capital, maybe more. Rich people love them some lotteries.